The goal is finding something that you truly love. Make sure it has intention behind it. Make sure it's going to make the world a better place. Put those two things together and I swear to you, success will follow, the money will follow, and you will change the world.
Today, we break down the rise and fall of Wework. The vision, the hype, the reality, the disaster, and the lessons that every entrepreneur, investor, and business leader needs to hear. This is Business Breakdown Channel. Let's get into it. In 2019, Wework was valued at $47 billion. The company was about to go public in the biggest IPO of the year. Adam Neumann, the charismatic founder, was about to become one of the richest people on earth. The world was ready to embrace the future of work. But then, in a matter of weeks, it all collapsed. The IPO was pulled. Neumann was forced out.
Adam Neumann basically is expected to step down as We Company's CEO.
Wework has officially come out and made a statement now saying that Adam Neumann is stepping down as CEO.
The company went bankrupt, and investors lost billions. How did a company that was supposed to revolutionize the way we work end up being one of the biggest business disasters in history? And what can we learn from the man who partied his way to a $1.7 billion exit? Adam Neumann didn't just want to rent office space, he wanted to change the world. His vision was simple: create a community where people could work, live, and thrive together. The we in Wework wasn't just a name, it was a philosophy. Neumann's pitch was magnetic. He talked about elevating the world's consciousness. He spoke of creating a movement, not just a company. Investors were captivated by his charisma and his grand vision. SoftBank's Masayoshi Son called him the next Steve Jobs. The early Wework spaces were beautiful. Open layouts, free beer, ping-pong tables, and a sense of community that traditional offices couldn't match. It felt like the future of work, and for a while, it was. But here's where it gets interesting. Behind the vision was a simple business model: rent office space, divide it into smaller units, and charge more per square foot. It was real estate arbitrage, not a tech revolution. What happens when you dress up a real estate company as a tech unicorn? In 2017, SoftBank's Vision Fund made the biggest investment in startup history, $10 billion in Wework. Masayoshi Son was convinced that Wework would become the world's most valuable company. He saw it as a platform that could expand into every aspect of life. The money flowed like water. Wework opened locations in dozens of cities. They acquired companies, launched new products, and expanded into residential spaces. Neumann's net worth soared to over $10 billion. The company was unstoppable. But here's the problem. Wework was burning through cash at an unprecedented rate. They were losing money on every location they opened. The more they grew, the more they lost. It was a classic case of growth at any cost. Strip away the hype, and Wework was a real estate company with a tech company's valuation. They leased office space from landlords, renovated it, and sublet it to companies at a markup. It was a simple business model that had been around for decades. The problem was the economics. Wework was paying market rates for prime real estate, then trying to charge premium prices for shared office space. The math didn't work. They were losing money on every square foot they leased, but Neumann kept the illusion alive. He talked about data, technology, and community. He positioned Wework as a tech platform that happened to use real estate, not a real estate company that used technology. Investors bought the story. The emperor had no clothes, but everyone was too mesmerized by the show to notice. In August 2019, Wework filed their S-1 document to go public. It was supposed to be the crowning moment of Neumann's empire. Instead, it became the document that destroyed it. The S-1 revealed the truth. Wework was losing $2 billion a year. They had no path to profitability. The company was essentially a Ponzi scheme, using new investor money to pay for old locations that were losing money. But the most damning revelation was Adam Neumann himself. The document showed that he had leased properties to his own company, profiting from Wework's losses. He had trademarked the word "we" and sold it to the company for $6 million. He was using company money for personal expenses. How do you go from hero to villain in a single document? The S1 was a disaster. Investors revolted. The IPO was pulled and Adam Neumann was forced to resign as CEO. But here's the kicker. He walked away with $1.7 billion. Neumann's exit package was outrageous. He got a $500 million credit line, a $185 million consulting agreement, and the right to sell close to $1 billion of his shares into a tender offer, together adding up to roughly $1.7 billion. Supervoting shares had given him near absolute control. The bailout monetized that control even as the company cratered. The S1 also surfaced a pattern of self-dealing. He personally bought buildings and leased them back to Wework. He trademarked the word "we," and the company paid nearly $6 million to acquire it. Money later returned after backlash. He borrowed from the company, then pledged stock against personal loans. Family members held roles inside the business. A private jet, lavish parties, tequila culture, and side ventures rounded out a governance picture that spooked public market investors. When SoftBank stepped in to stabilize the company, the rescue prioritized control and runway. Neumann exited with liquidity and a consulting fee. Employees faced layoffs and underwater equity. Creditors tightened terms. Locations were closed, leases renegotiated, and growth plans unwound. The founder left rich, and the company began a slow retreat from the story it had sold. Wework limped along for years, but the final blow came from an unexpected source: COVID-19. When the pandemic hit, offices emptied out overnight. Enterprise clients froze budgets, startups canceled memberships, and month-to-month members churned en masse. A model built on long-term lease obligations and short-term revenue was suddenly upside down. Utilization cratered. Desks that once boasted near-full occupancy fell to historic lows. Locations that had relied on dense seating and shared amenities now faced distancing rules and heightened cleaning costs. The unit economics worsened precisely when cash was scarcest. Landlords still wanted rent. Members no longer wanted desks. The debt stack swelled while growth engines seized. WeLive and side projects were wound down. International markets were pruned. Management shifted from expansion to triage, renegotiate leases, shut unprofitable locations, and conserve cash. In city after city, Wework sought rent abatements, deferrals, or exits, anything to match fixed obligations to collapsing demand. By 2023, the math was unavoidable. The company entered Chapter 11 to restructure. The filing aimed to reject burdensome leases, refinance debt with debtor-in-possession financing, and reset the footprint around a smaller cash-generative core. Creditors took haircuts. Equity was diluted. The brand survived, but the business model was rewritten under court supervision. Inside the process, every lease became a decision point: assume, renegotiate, or reject. Landlords faced hard choices: accept lower base rent and longer terms, or risk dark space in a weak office market. Some deals were salvaged with blended rates and free rent periods. Many locations closed. The post-bankruptcy map showed a tighter network clustered in markets with resilient demand and favorable lease resets. And yet, the irony remained. The pandemic validated parts of the original thesis: flexible, short-commitment workspace, matters in a volatile world. But WeWork's pre-pandemic cost structure, prime long-term leases signed at the top of the market, made flexibility expensive. When volatility spiked, the liabilities won. The vision was right, but the execution was a disaster. WeWork's collapse teaches us 4 critical lessons about business, investing, and leadership. Lesson 1. Vision without execution is just storytelling. Adam Neumann had a compelling vision, but he had no idea how to make it profitable. Great ideas mean nothing without a viable business model. Lesson 2. Growth at any cost is a recipe for disaster. WeWork expanded too fast, too recklessly, without ever proving their model worked. They prioritized growth over profitability, and it destroyed them. Lesson 3. Charisma can be dangerous. Neumann's magnetic personality blinded investors to the fundamental flaws in his business. They fell in love with the founder, not the company. Lesson 4. Corporate governance matters. WeWork had no checks and balances. Neumann could do whatever he wanted, and it nearly destroyed the company. Good governance isn't optional, it's essential. Will you be the next investor to fall for a charismatic founder with a great story? Now that we've seen how WeWork collapsed, let's turn this into actionable intelligence. Every investor faces the same challenge. How do you separate real innovation from clever storytelling? How do you spot the next Adam Neumann before he takes your money? The truth is, most business disasters follow the same playbook. They promise revolutionary change, show impressive growth, raise massive funding, and have charismatic founders. But behind the curtain, the business model is fundamentally flawed. Here's your 5-point checklist to avoid the next WeWork disaster. Use this every time you evaluate a startup. Whether you're an angel investor, venture capitalist, or just someone who wants to understand what's real and what's hype. First, demand to see the unit economics. If a company can't make money on a single unit, they can't make money at scale. Second, look for real competitive advantages, not just marketing. What can this company do that others can't? What's their moat? Third, check the corporate governance. Are there independent board members? Can the founder be held accountable? Is there proper oversight? Fourth, verify the growth metrics. Is the growth sustainable? Are they acquiring customers profitably? Or are they just burning money to look good? And finally, fifth, separate the founder from the company. Great founders can build great companies, but the company must stand on its own merits. So, what does WeWork's collapse teach us about the future of business? Here's the brutal truth. WeWork failed not because the vision was wrong, but because the execution was a disaster. A company that reached $47 billion in value ended up being a cautionary tale about the dangers of unchecked ambition. The lesson is clear. Great vision without great execution is just expensive storytelling. Markets reward companies that can deliver on their promises, not just make them. If you want to build something lasting, focus on the fundamentals: unit economics, governance, and sustainable growth. Let execution, not expectation, do the compounding. Thanks for watching. If you found this breakdown useful, subscribe for more deep dives into business disasters and what they teach us. We've covered Theranos, Nikola, and now WeWork, 3 of the biggest business failures in recent history. Next up in our series, we'll dive into the world of cryptocurrency disasters. From FTX to Terra Luna, we'll explore how the crypto boom became the crypto bust, and what it teaches us about the future of digital assets. But first, let me know in the comments, what's the most outrageous business failure you've heard of? And what do you think we should cover next? This is Business Breakdown Channel. Until next time, remember, Execution beats expectation every time.